Good morning, everyone. I want to welcome you to our Index Universal Life, Understanding Index Universal Life webinar this February 6th, Monday morning. Today, we have as our presenter joining us Sandy Petrie. Sandy is the Life Sales Director for Mutual of Omaha and United of Omaha. Good morning, Sandy.
Good morning. Good morning.
How are you this morning? It's a beautiful day here in Nebraska anyway, isn't it?
Yes, it is.
Well, why don't we get started with Life Full Throttle. Everyone should be seeing that page on that, and we're going to be talking about not only United of Omaha's Index Universal Life, but a lot of general principles that have to do with Index Universal Life and how they operate, what they are, and how to illustrate them, which are very important points in your sales and getting prospects for them. So Sandy, take it away.
Oh, great. Thank you very much. As Mark mentioned, what I am going to cover today is just generalities regarding Universal Life, kind of how they operate, how they're a little bit different than some of the other Universal Life policies out there. Talk a little bit about the different types of accumulation UL policies, but again, focus on the Indexed Universal Life. Also, who the target market is for the Indexed Universal Life. And then I'll touch briefly on our product, which is called Income Advantage Indexed Universal Life. So first of all, what is universal life insurance? It is a form of permanent life insurance coverage that allows for flexible premium payments. It can provide cash value accumulation potential or a guaranteed death benefit, and may include additional riders and coverages similar to some of the other life insurance products. Now, two common types of universal life policies in the industry are guaranteed and accumulation. Now, the accumulation, it's sometimes called current assumption policies. So today, though, I will focus on the accumulation policies, specifically the indexed universal life coverages. Now, the basic difference between guaranteed and accumulation products is protection versus cash accumulation. So guaranteed universal life offers a guaranteed death benefit, but little or no potential for cash accumulation. On the other side, accumulation universal life products are designed to grow cash value that can be used during the policyholder's lifetime, typically, 10 years, 20 years, 30 years out, depending on what they want to use the cash value for. Now, accumulation universal life policies, again, they do have that potential to grow the cash value tax deferred, which can be accessed by the policy owner through loans or withdrawals. Their flexibility allows the client to change their premium payments and the death benefit. Under the terms of the policy, the excess of premium payment that's above the current cost of insurance is credited to the cash value of the policy. The cash value then is credited each month with interest, and the policy is debited each month by the cost of insurance charge, as well as any other policy charges and fees, which are drawn from the cash value. So even if there's no premium payment made that month, there's still going to be interest accredited to that account. So as you would imagine, if a policyholder overfunds this policy, meaning pays an amount well above the cost of insurance and other charges, that is going to substantially increase that cash value over a period of time. Now, there are three basic types of accumulation life insurance products, and they differ by how the interest is credited to the account. So there's an interest-based universal life, which provides like a stated or fixed interest rate. There's the indexed universal life, in which the interest is linked to the performance of a specified index. Then there's variable universal life. That is tied to an investment account, such as a mutual fund. So the interest-based universal life grows the cash value through a set interest rate that is specified by the insurance company. Now, these rates are subject to guaranteed minimums, which are generally between 2 and 3%. And of the 3 accumulation UL products, the interest-based UL offer the lowest variability for returns because you're paying a lower premium, so not a lot of cash value is going to build up into this policy. The index universal life, the interest is linked to the performance of an underlying index, such as the Standard & Poor's 500. The interest earned is subject to caps and floors and is calculated and credited during a specific time period, which is often, say, a 12-month time period. So when paying monthly premiums, each month payment will be giving its own individual calculation. So therefore, the policyholder may have 12 separate rolling annual crediting periods that earn interest. And I'll explain this a little bit more in the upcoming slides. The returns on an IUL are generally mid-level. And because the floor is generally set at 0, there's really no downside risk. So they're not going to lose money if the stock market doesn't perform because that floor is 0. Now, indexed universal life, they're becoming tremendously popular within the U.S. market for the universal life products because of that benefit of being able to build up cash value at a tax advantage. Variable universal life, on the other hand, this allows the policy's cash value to be directed into subaccounts that operate similarly to mutual funds. So these subaccounts can be tied to stocks or bonds, which may provide higher potential for growth, but on the flip side, there's a greater risk since there's no downside protection included through a floor. In addition, there are certain producer licensing requirements to sell variable universal life. Okay. So let's focus on the indexed universal life in more detail then. So as I mentioned, it has death benefit protection, strong cash accumulation potential, that floor, which gives it that downside risk protection, and there's tax-free loans and withdrawals that can be used in the future for other expenditures. Okay. All IULs offer interest that is tied to the performance of an underlying index. Carriers determine if they'll offer one index or multiple indexes. The most commonly followed index is the Standard & Poor's 500 because it is the widely regarded as the best representation of the U.S. stock market performance. But there are other ones, the Dow Jones, the Euro Stoxx, to name just a few. The interest calculation is based on 4 factors: participation rate, a cap, a floor, and the crediting period. Let's look at each of these in detail. So the participation rate, this is the percentage of the change in the index that will be credited to the policy. The rate can vary from below to above 100%. Usually depends on the cap, okay? Now the cap is the pre-established maximum interest rate that can be credited to the policy. Generally, the higher the participation rate usually means a lower cap. A lower participation rate usually means a higher cap or no cap. And I'm going to go through some calculations just to show you what I mean exactly by this cap in some upcoming slides. Now the floor, This is a pre-established minimum interest rate that can be credited to the policy. It's usually set at 0 to provide that downside protection for the policy holders. What this means is that even if the index rate goes down below 0 to a negative, the credit interest rate will never be less than 0. So the client will never lose money. The crediting period is the length of time during which the interest will be calculated. The account will only receive interest at the end of the crediting period. So for each premium payment made during the year, a new crediting period or bucket is established. So there are multiple crediting periods that carriers can use. So for example, an annual point-to-point crediting method of the value of the stock is calculated beginning and ending on the same day each year. So if January 15th, 2017 is set to be the starting point, the difference between the index value on that date and the end date, which would be January 15th, 2018, would be the index value. Okay, so think about it. You have 1 month and a year later on the exact same time, they're going to look at the difference between the index to see what the value is of that index, how much it increased. Okay, monthly point-to-point and multi-year point-to-point, they're calculated actually the same way. It's just with different time periods between the start date and the end date. And then monthly averaging takes the value of the index at the end of each month and then sets the index value based on the average of all 12 months in the year. Okay, so that's your crediting period options that can be available. Insurance companies may offer different crediting strategies for their policyholders to choose from, and these may differ based on crediting period and participation rates, cap rates. Most policies allow the policyholder to allocate funds to one of these strategies or a couple or all of the strategies that are available. That just allows more flexibility and diversification of how the money is allocated to these different crediting strategies. So let's look at an example, okay? So with this slide right here, I have a crediting strategy with a 100% participation rate and a mid-range cap. So in this instance, the cap is 11.5%, okay? 100% participation rate, a cap of 11.5%, the floor is 0. So let's just say that the Standard & Poor's value at the end of a year for any given bucket is 12.5%. That's above the cap. So the interest rate that's going to be credited is set at the cap. So that would be 11.5%. Let's say, for example, the Standard & Poor's return was 4.07%. Now that's below the cap of 11.5%, so the interest credit rate is going to be 4.07%. Okay? Now you have 100% participation, the cap 11.5, again that floor is 0. What happens if the annual Standard & Poor's 500 returned 30%? Again, that's above the cap, so the interest is going to credited would be 11.5%. Okay, so I showed the calculation there so you can kind of see exactly how this crediting strategy works. Okay, one thing to note, if for example the Standard & Poor's 500, let's just say, is a negative, the interest credited would be 0 because of that floor. So they're not going to be credited with a negative interest rate that's going to eat up the value they've built up. They're just not going to get any interest credited for that particular bucket of money or that particular period of time. Okay, this is another indexing strategy that may be available. So 140% participation rate and a lower cap. Okay, so let's say participation rate is 140%, the cap is 8.5, The floor, again, is 0. In this example, 12.5% is the Standard & Poor's 500 return. So that, again, is higher than the cap. So 8.5% is going to be credited towards the interest, okay? The next example, 4.07% is the return. So the interest credited is going to be 5.7%, okay? And then the next example, 30% Standard & Poor's 500 return, is, again, that hits that cap, so it's going to be 8.5% is credited for that period of time, okay? And again, that floor is 0, so even if it's negative, it's not going to decrease the value of the interest. Okay, there's another strategy that might be available. Okay, a 65% participation rate with no cap. Okay, floor of 0. So as you can see, given our same examples we've been going through, a 12.5% return, that is going to equal 8.13% interest credited. If it's 4.07% return, that interest credited is going to be 2.65%. And then again, we have our 30% return. That one's going to be higher, 19.5% return. Okay, and again, that floor is 0. So as you can see, each of these crediting strategies, they have their benefits. And if somebody wants to, they can put half of the money into a 100% strategy, and half of the money that they're paying for their premiums into the 65% participation rate with the no cap. It all just depends on what they're comfortable with. Okay, each of them has their advantages and disadvantages. So depending on how they feel the underlying index is going to perform, that might sway them to pick one strategy over the other strategy. Okay. Now the IUL target market. These IULs are really a good choice for clients who have a need for life insurance, because this is life insurance, but are also looking for the chance to grow cash values that can be accessed at a later date for things like retirement, college tuition, or emergency funds, or maybe they just want to save up for a vacation home later in life. They can certainly use the money for whatever they want to use it for. Okay. So the first target market for the Indexed Universal Life is that young professional. The policy's death benefit can help protect them and their loved ones and provide that financial security and replace loss of income. But again, also the cash value, young professionals may be interested in building that cash value to provide for uses in the future. As I mentioned, they can create an education fund for their children. They can supplement their retirement money. They can accumulate that emergency savings, or they can pay off their mortgage only or other debts early, whatever they want to use that for. Generally, we see a lot of young professionals trying to put more money into this because they're going to be able to withdraw that at a tax advantage status later on via loans and withdrawals. Okay. Pre-retirees, they're another target market for the Indexed Universal Life. They may see the policy's death benefit as an ideal way to protect loved ones' financial security, replace that lost income during their peak earning years, or with help with estate planning needs. Pre-retirees may also be interested in the cash accumulation potential for such things as paying off that mortgage, debts, also creating that education fund for their grandchildren. Don't forget about the grandchildren. This can be used for whatever they want. If they want to help pay for their grandchildren's college, they certainly can. Can also help for unforeseen emergencies. Okay. Now, while it's not common, under special circumstances, retirees may see the need for an IUL product. IULs are designed to where they can pay a single premium. So if they do have a lump sum of money, they can purchase a IUL policy. Now, the death benefits provided with the policy can help these clients protect their spouse or partner, while the cash accumulation potential may be used to help retirees cover tax needs in the future. So don't just limit this to young professionals. It does have a fit in certain situations for those pre-retirees and retirees. Okay. Finally, indexed universal life may be an ideal choice for small business owners because it works well for business planning, succession planning, and business continuity needs. In particular, it fits with the following marketing concepts: key employee, buy-sell agreements, and estate equalization strategies. So don't just limit your small business owners into a term insurance. There is sometimes a need for the IULs in the small business market. All right. So what I'm going to cover now is I am going to cover our universal life product. It is called Income Advantage. Our product, it's tied to the Standard & Poor's 500 index, and we did choose the Standard & Poor's because it is, again, the most commonly followed index, and it's regarded the best representation of the U.S. stock market. It has a lower volatility than other indexes, and it's the most popular choice amongst IUL policyholders. Okay, our product, each payment into a bucket will be credited the amount of interest over a 12-month period. So it's a year point to point for each bucket. So think about it like this, as I explained before. In, let's just say, February 1st, I made a premium payment. A year from now, that premium payment, we're going to look at what the index change is, and that is the amount that's going to be used to calculate the interest credited for that payment. Okay, so if it's you make monthly payments, they go through that every month when a monthly payment is made. If they make annual payments, again, it's still 1 year. Every time a payment is made, they look 1 year later. Okay. Now, our product has 3 crediting strategies. It happens to be the same crediting strategies as I illustrated before. So the uncapped with 65% participation rate, 11.5% cap, 100% participation rate, and the 8.5% cap with 140% participation rate. We also have a fixed account that is 3.25%. So if they want to put money into a fixed account, they can. If they want to put half of the money into a fixed account and half into the 100% participation rate strategy, they can do that. And again, the floor is 0 for all the strategies. Okay. Now, we have 4 riders that are included with a policy at no charge. These are a huge benefit when you're looking at the policies. We have a guaranteed refund option, or we call it the GROW rider. We have an accelerated death benefit rider for chronic illness, an accelerated death benefit for terminal illness, and the lapse guard. Lapse guard is key with these policies because the last thing you want is for a policy to lapse. All right. So the guaranteed refund option rider, Income Advantage is the only IUL in the market that provides peace of mind to your clients. If for any reason the market does not perform up to its potential, the insured can receive a refund of up to 50% of the face amount of their policy. So the guaranteed refund option, the way this works, there are 7 60-day windows in which the policyholder can surrender the policy and receive a refund of premiums. So the way that works is in the 15th policy year, they can get 50% of their premiums back. At the end of year 20, 21, all the way through 25, they can get 100% of their premiums back. Now, that is capped at 50% of the policy face amount. But think about it this way. If the market is just not performing year over year and they're not getting the interest rate that they were expecting or anything even close to it, they're not going to lose money because of that floor, but this is a way for them to get their premiums back and go a different direction. So think about it like a little safety net, just in case the market doesn't perform. That's the way I like to look at it. Now, there are 2 accelerated death benefit riders included with our Income Advantage policy. These riders can help cover long-term care type expenses, medical bills, or other expenses should the policyholder become ill. Okay. The accelerated death benefit rider for chronic illness provides early access to the death benefit if the insured has an illness that make them impossible to perform 2 of the 6 activities of daily living for 90 consecutive days, or they experience severe cognitive impairment. So the way that works is they would be able to say, I want to access my death benefit. I'm unable to perform 2 of the 6 activities of daily living. They request a lump sum be paid to them. They tell us the amount, we do the calculations, and we provide them with a lump sum check that they can do whatever they want with that. They can use it to help pay for home health care services, for nursing home. They can make some home modifications. They can take the money and hire a nurse, whatever they need, and go on a luxury vacation. We really don't care what they use the money for. And then the remaining benefit stays in the policy as a death benefit that can be used at a later time. So not only can they accelerate once, they can accelerate multiple times. Okay. Now there is an accelerated death benefit rider for terminal illness. So if the policyholder has a 12-month or less life expectancy, they can accelerate the death benefit out of their policy, okay, and the policy terminates. Now, the lapse guard, what this does, this enables or makes it so the policy will not lapse. So let's just say you have a client that's overfunded this policy. They've been putting in a lot of money into the policy, and they have level disbursements that they're taking out over a period of time in the future, maybe to use for retirement. So what happens then is you want the policy to stay in force, because if the policy doesn't stay in force, there could be tax consequences. But the lapse guard is intended and designed to kick in at the opportune time so that the policy does not lapse and there's no tax consequences from taking out cash out of the policy. Okay, so that's built into the policy. It's a safeguard to protect the client against tax consequences in the future. All right. Okay, so that is actually the end of the presentation. I hope that you have enjoyed it. I am available to take questions if anyone does have a question.
Thank you, Sandy. We do have some questions out there, and we'll try to address those right now for those that posted questions. First question up was early in the presentation. Someone asked, can you explain the term floor? And I guess I'll step in here, and the floor is the minimum interest rate that will be charged for that interest rate that you picked. And with United of Omaha's life product, the floor is 0% for all the interest rates that you can pick, and except for the fixed one, I guess all of the indexed rates you can pick. And so you will not lose money. There is not a negative interest rate of losing money because you picked the index rate. But given a little question later, we need to make sure that you understand cost of insurance, policy fees, those kind of things are still being charged out of the account. So the premium needs to cover that. If the premium covers that, you're not going to lose money. Correct, Sandy?
That's absolutely correct.
Okay, here's one for you. Does the value stay the same in the account? I think they're referring to the index values in there. How would you explain that, Sandy?
Does the value stay the same in the account? Now, if you're talking, it doesn't. If you're talking about the accumulated cash value, no, that doesn't stay the same. Assuming you're paying, enough premium to cover that cost of insurance, et cetera, and the policy charges, there's always, unless you hit the floor, going to be interest credited to that money. So you should see the cash accumulation increase over the years. We can run illustrations that will give you a good idea of if the market performs on a steady basis, say like at 6%, what the cash value is going to build up to be. So the illustrations are really good at showing what the increase in the value of the policy is going to be.
And if you're talking about the index value itself, if you're making monthly payments, you have 12 monthly buckets. And if you pick the annual point-to-point, it looks at those points every month a year from now. So if you put in the premium and put in extra and it's at 6%, the S&P 500 this month, you get a 6% credit for that amount of premium for that month. Next month you put in the same amount of premium, but the S&P 500 has gone down to 4. You start off with that 4, and then it looks a year from now for each of those buckets to do the crediting of that strategy. So we're trying to hit both. I'm not quite sure how that question is, if it's referring to the cash value or the index value. And we'll be, if you have more questions on that, make sure you call one of the marketers here at Premier. We have a 800 number, 800-365-8208, and excuse me, 8209, and we'll get that to you here at Premier, and you can talk to somebody in our life marketing, and we'll get you that information. Next question was, explain the participation rate. Well, the participation rate is a fund, just like index annuities. It's the amount of the fluctuation that the interest rate changes is how it's going to be applied. So, I think the easiest way, yeah, Sandy, you got that up on the board. It helps you decide which participation rate to put it in. And you and the client are able to change that participation rate or that index that you pick. You're able to change the index rate that you pick on an annual basis every year if you pick the annual point-to-point. So every year you look at that. And if you think the interest rates are going to be hanging around that cap or somewhere in there, you want to do a 100% participation rate that hangs around that 11% figure, with a zero floor. So you're always getting the maximum. But if you look at a case where you don't think the S&P 500 is going to perform very well this year, you think it's going to hang around less than 5% for this next year, then you might look at the 140% participation rate, because now those low interest rates you're going to get credited than what the actual S&P 500 actually participated at. And if you think the S&P 500 is going to really skyrocket and do double-digit returns on your markets, then maybe you want to do the no cap option. And there, the insurance company is protecting their side, but you're getting the benefit of getting that no cap and the highest participation. The rate you can get is 65, but you're taking advantage of 20, 30, 40% cap increases. So consequently, how you think the market's going to do for the next year is where you want to put your money. Again, If you think it's going to be doing low, you got one choice. If you think it's going to do here, but you can always put in percentages into the different rates as long as the total adds up to 100%. So what we'll find a lot of people doing a certain amount into the fixed rate where it's already at 3% rate and the floor is 3% for that year. You know it's not going to get any more less than that, or 25 and 25 and then a couple other strategies. So it really depends on where you and the client decide or project where the market's going to do for that time period you've chosen. These are great slides, Sandy. They really do a good job there. Anything you can add?
What I would add to that is most people do pick just the 100% participation rate with the, kind of the mid-range cap in there, just because it's typical of what generally is happening, especially with the Standard & Poor 500. But again, there could be those large swings, but you can never go wrong with, I don't think, by choosing 100% participation strategy with the 11.5% cap. Put half of the money in there if you want, and then put half of the money into the fixed account. So you just can't go wrong, really. You're always going to get some interest.
And the other question this individual had, when can you make changes in the strategy? You can make changes at the end of the period. So if you've chosen a one-year strategy, you can change it again a year from now. Mm-hmm. And it applies for the whole year. If you chose the month-to-month strategy, monthly strategy, you can change it on a monthly basis. So you'll want to be aware of that also. Again, somebody else asked if the markets are down 3 years in a row, there'd be no negative effects in the extra that you put in, but you still need to cover your cost of insurance and make sure your premiums are covering that. Next question is, typically how soon are cash accumulations available to the policy owner? How about that, Sandy?
Okay, typically cash accumulations generally start building within like 2 to 3 years. Of course, it's going to start slow and then increase more rapidly, of course. But what you want to remember with these indexed universal life products, especially ours, it really is intended to be used for a savings vehicle for the future, for that retirement, for that education. The illustration software will allow you to illustrate disbursements via index loans, for example, in the future, so you can see based on the illustration, the cash accumulating, and then you say, for example, you stop making premium payments and then you start taking disbursements. So you can see that what type of money the client would be able to access at a later time. So keep in mind, always you try to get those illustrations for your client. It's the best way to kind of demonstrate how this policy is going to work for them.
Okay, next question. Is this product available in the state of New York?
Yes, it is, actually. Our product was approved in New York probably about 3 months ago, so yes.
Great. Also, we have a question here. Can you give some examples of what is needed to properly fund those policies with different face amounts? I think basically on Index Universal Life, you and the client need to be aware of, the ranges of funding. Every policy based on the age of the client and the face amount has a target premium, which I like to say for the purposes of illustration is the minimum premium you want to sell to, and a guideline level premium and a MEC premium. Target would be the least I would encourage the client to go to and just barely funds it and puts a little bit into cash based on what you're doing. Guideline level is the most opportune amount that covers the cost of insurance and also puts money into the account for the purpose of cash buildup. And then the MEC amount is what still is the maximum amount of insurance you can put into the policy and still have it listed as an insurance policy based on the IRS guidelines and rules. So if you got questions on those, typical things like that, please give us a call here at Premier. We will run illustrations and can show you that same policy with different funding options and show that so that you can present that to the client. Again, are there, very important one here, are there any slides like this that would be appropriate for agents to use in a presentation to the client, Sandy? Do we have anything put together that is client approved?
You know, as far as these type of illustrations, there really isn't, but I would definitely recommend using the illustration. It is designed to be client-facing. It does have the various options on there. It talks about the S&P 500 in general. There's other tools out there that will give you a good idea as far as what the average S&P has been over the last 100 years. So you will have a really good idea. We also, on our illustration software, have some concept pieces. So, for example, if you have a client that is looking to supplement their retirement income, there is a fabulous consumer piece that comes with the software that you can run that will show them with nice graphics and bar charts as far as how much they can accumulate and how much they can pull out later. So that's what I would use. The other one that is available is saving for your child's tuition. So it will definitely show you, you can pull out, $50,000 a year to pay for your kid's college and still have the insurance for later on too. So that's what I would recommend doing if you're wanting to talk to a client about a different strategy. Of course, we do have nice, colorful brochures that talks about the income advantage and how it works that you can use for the client as well. So I would recommend, the illustration and the large brochure that we do have available. There are a few hypothetical examples in that large brochure, similar to what's on the screen here, that would help you talk to the client. So definitely look for those.
All right, I think we've hit all the questions there, Sandy. I want to thank you for doing this webinar for us. One of the things, we will have a recorded version of this webinar available. It will be available through our web page and available from any marketers from Premier Life Annuities. So please feel free to email us or give us a call. We will also make available and have available illustrations, the consumer brochure, and also a product guide from United of Omaha on this product to help you go through and explain and help you educate yourself on this product. And I can suggest that you as an agent, if you're looking at this the first time, we need to get you familiar with, first off, their IUL, which is a great universal life product that has the interest rates already chosen and understand how it works, and then move into the Income Advantage IUL and get you familiar with that. So with that, thank you, Sandy. Thank you, everyone. We look forward to getting a hold of you. Someone from Premier will be contacting you from email or on the phone. Feel free to give us a call in the meantime as you get time. So look forward to our next webinar, Sandy, that's coming up the end of this month. We're going to be talking about combination products. In other words, in using case design for using multiple products to solve issues with one case. How can you do the best job for your clients? So we look forward to everyone to being on that webinar 3 weeks from now. So thank you, Sandy. Thank you, everyone.